Hi, my name is Vivek Dhar. I cover mining and energy commodities research for CBA. Today, I wanted to talk about Australia's carbon credit unit market or Australia's carbon market. And in that, I wanted to cover the analysis of changes or proposed changes to the safeguard mechanism and the Chubb review and the implications for Australia's carbon market. So, with that, I first wanted to talk about the safeguard mechanism. So the safeguard mechanism accounts for about 28% of Australia's carbon emissions. And basically, it captures roughly about 215 facilities across Australia that emit more than 100,000 tons of CO2. Now, the mining sector features prominently in terms of the facilities that are captured under the safeguard mechanism, but there is also significant exposure to manufacturing and even further downstream. In terms of what we're seeing in respect of what success is defined according to the government is that they are looking for the safeguard mechanism to do their fair share in reducing emissions in line with the rest of the economy. And that means a 43% reduction in carbon emissions from 2005 to 2030. With that, they have set some goals, a carbon budget, and a key goal by 2030. And in achieving that, the position paper that was released in January actually put out for the first time how the government plans to do that with reduction rates in baselines. Now, these baseline reduction rates are based on emissions intensity. So if you were an aluminium producer, you'd be looking at what is your CO2 per unit of aluminium produced, or for every other entity, they would have a different target to reach. Now, for the entire mechanism, the reduction rate is, or the emissions reduction rate is about 4.9% a year. But the analysis actually shows that that's true for the first year, and that actually accelerates every financial year till 2029, 2030. Now, we've done some modeling to see how sensitive the modeling to the safeguard mechanism is. And from what we have observed is that if we see production growth rise enough, or in our view, above 0.3% for existing safeguard facilities, then there's a strong risk that by 2026, 2027, when the government reviews the safeguard mechanism next, we could see those production adjusted baselines become more aggressive in the back end of this decade. Now, the other key sensitivity to look out for is how tolerant is the safeguard mechanism to new emissions. And that's from not just from existing safeguard facilities, but even new safeguard facilities. And what we find is that from 2023, 2024 to 2025, 2026, if we see 3 to 5 million tons of new emissions added, which is roughly between 4 to 6 average safeguard facilities, that also means that by the back end of this decade, after the government's review, we could see those production adjusted baseline rates become more aggressive. So watch that space carefully, because it's the government that is looking at absolute emissions, and they'll be tracking that over the next few years. Every facility will be looking at their emissions intensity. So the government may adjust baselines at the end of this decade. So now looking at supply and demand. If we look at demand, the way that we've looked at it is from two angles. So we're looking at what is the new demand for ACCUs, and we're looking at what is compliance demand, and this is going to be driven by the safeguard mechanism. And so entities will have to buy ACCUs if they reduce emissions intensity, but not by the degree that's needed by the safeguard mechanism and its demands per facility. They'd have to purchase ACCUs, and this is what we call compliance demand. And then we also have voluntary demand. So this is entities that are purchasing it outside of any obligation. Now, the way that we've tried to model how the safeguard mechanism will actually reduce emissions intensity is that we've looked at the national electricity market and seen what that has achieved from 2014 to 2021. Now, what we've observed is that in aggregate, in the 7 years from 2014 to 2021, the, the, the national electricity market achieved about 24 to 25% reduction in aggregate emissions intensity. Now, the safeguard mechanism is looking to achieve roughly about 34 to 35%. The reason why we have looked at the national electricity market is that when we look back from 2014 onwards, that's when we started seeing significant cost reductions in renewable costs, particularly solar and wind. And if this is replicated for safeguard mechanism facilities, then they could potentially follow the same path. Now, we think it will be very challenging to achieve what the NEM did in the 7 years from 2014 to 2021. So in our low demand case for ACCUs, we've assumed that the safeguard mechanism can replicate what the NEM did. Now, when it comes to voluntary demand, this is very difficult to predict. It's grown 40% in the last 2 financial years, and picking how it'll grow over the next 7 financial years will be very tricky. And so we've put sensitivities around that. And you can see that our demand forecasts for high case, base case, and low case. And what we now have to try and examine is, can we get new supply to meet this new demand over the next 7 financial years? Now, supply is more complicated. Not only do we have to look at what is the new supply that's coming through, which isn't generating ACCUs just yet, we also know the government is reducing demand for ACCUs. And we are expecting those ACCUs that the government is no longer going to be surrendering become available to the market. So putting that together alongside some data from the CSIRO and their potential sequestration report, we have the supply scenarios you can see in the chart there on the right. Now, we've looked at new supply and we've looked at existing supply from carbon abatement contracts, which are currently contracted to the government. Now, if we put together the supply and demand picture, we can see that in our base case that we have a relatively balanced market. And we see that the risks are skewed pretty evenly between a high ACCU price and a low ACCU price if we look at the different scenarios. But just some comments on our analysis and our conclusions. When it comes to supply, there's going to be a key source of uncertainty with soil carbon projects. Now, this is a big chunk of new supply that's coming online, and how it performs will have a material impact on the analysis. In terms of how new supply could potentially be higher than what is our base case, we know the Chubb review and its recommendations is looking to boost new supply growth via proponent-led supply methods. And this is something that could certainly make the low ACCU price scenario a possibility. And finally, the government is going to be the source of final demand for fixed capped Australian carbon credit units. So they have said that they are willing to offer in 2023, 2024, ACCUs at $75 cap, and that'll rise by 2% plus inflation every year after that. Now, how the government will source these ACCUs or these fixed cap price ACCUs is going to be a risk factor going forward, particularly given that there's strong incentives right now for those that are currently contracted to supply the government to exit those contracts and supply the secondary market. So if you have any questions at all on our note and our analysis, please talk to Australia's carbon market team. And if you want further details on this research, please visit our Global Economics and Market Research website. Thank you.